Right, there we go. Welcome, everyone. Welcome, welcome, welcome. Lovely to have you all here. I'm going to pull my slides up. There we go. You are all very welcome to introduce yourself in the chat. If you click on the chat, click on the blue button to click everyone, not just a panel and hosts. You can introduce yourself and where you are calling from in the chat. But for now, we'll hold on just one moment while everyone comes filtering in. Andrea can maybe kick us off by telling us something interesting that's happened so far in Yunga, Climate Week that's happening. Andrea,
My
tell us something
goodness.
interesting that's happened so far at Climate Week.
Yeah, I followed Climate Week more than the General Assembly activities this week. And hi, everyone. Andrea Armeni, based in New York. Hence the question. Crazy days around here now, not just in terms of traffic, but also everything that is happening. We had a very interesting event on Monday on the relationship between climate issues and governance and ownership, which very much ties into what we are talking about today. Yeah. So that was a good sign, and it was so well attended, which surprised me on Rosh Hashanah and on the first night of Climate Week. But I guess this topic is something that people are exploring now, so I'm glad we have a chance to dig into this kind of exits aspect of it today.
And what was the outcomes of the session?
There would be a bit much to expect from a
Yeah,
from a 1 hour session, but a realization is what I took away, that this is hard work, but it needs to happen. Going
okay,
back to the usual point that we're not going to get out of the problems that we have gotten into by using the same financing structures and by using the same governance structures. So.
okay, that makes sense. Okay, great. Well, thank you. All right, so we've got a few people on board. Welcome, everyone. My name is Ani Patton Power, and I am the program convener for the Oxford Impact Finance Innovations course, as well as a number of different hats. And I am looking forward to having a conversation with all of you today about impact enhancing exits. And to do this, I have asked two good friends to join me. Andrea Armini is joining from New York, from NYU, and Tina Fisker Henriksen is joining us from Denmark, from the Bestseller Foundation. And both of them are speaking from a lens of having thought a lot about exits and the ways in which we need to use capital differently to create additional impact. And we are going to be diving into a conversation with them after I do a quick presentation. So I'm going to go ahead and throw my slides up and talk a little bit about what an impact enhanced exit could look like. Here we go. All right, so I will caveat this by saying that this is very, very, very early work. We are actually embarking on this work now as part of the Innovative Finance Initiative, a mission on particularly on alternative exits that will kick off next month. And so we're hoping to have a variety of resources and of thinking that goes into this. So right now I am sharing with you very early thoughts on what an impact enhancing exits could look like. And this, I would say, is a step further than the conversation previously, which has really been around responsible exits. And even then, not necessarily as important, I think, for a lot of funders. Bluemark, which does a verifications around the impact standards, consistently finds that exits are the place where the organizations score the lowest from a compliance to the impact standards. And that is because often it is something that is pushed down the line. So I want to start us out with a quote, which is, "We are continually faced with a series of great opportunities that are brilliantly disguised as insoluble problems." And I think that's the reason that that's up here today is that often we think about an exit as something that needs to be, solved for, that kind of at the end of our investment. And what we are going to discuss today is ways to actually integrate exits into the value creation, not just the continuation, but even additional value creation. So why do exits matter? Exits are not neutral. They can create impact, but they can also destroy impact. And I would love anyone in the chat to throw in an example that you've seen of where an exit has destroyed impact or tried to destroy impact. A good example, I would say, for instance, is Ben and Jerry's, whereby the owners, the previous owners, are still quite upset about what has been happening to the organization. We probably have between us many that have done that. Traditional exit pathways, as in with most traditional investing, even impact investing, prioritize financial returns over stakeholder value, and exits determine who owns, benefits, and holds power in businesses. So impact enhancing exits would increase the impact through thinking about that benefit and power. And these types of alternatives that we'll discuss are ways to think about how to further increase that impact. So the set that I'm going to go through relatively quickly for our conversation include employee ownership or buyouts, nonprofit buyouts, community buyouts, redeemable equity and other types of dividend exits, impact buybacks and redemptions, and then impact mergers and acquisitions. And again, this is early thinking, so this is very much a prototype of what will come in the future. So many of you are familiar with employee ownership. There are many benefits to employee ownership that have been long documented. And one option for any organization exiting is to essentially sell that business to the employees. And there are ways to do that, like Cal Solar did, which is an example from my book, Adventure Finance, around employee ownership, whereby the founders really wanted to be able to create long-term sustainability for the organization, and they knew they needed to do it in a specific way, which was to standardize how the voting happened, but also to think about affordability for the employees. And this was exceptionally important that the employees be able to participate. And so they did that as paycheck deductions. They worked with organizations that do employee ownership, and were able to really do a buyout that worked for the new owners of this business. And employee buyouts, particularly in the United States and Europe, where there are a significant number of businesses that are needing to sell from single owners, are a very interesting option to be able to create more distribution of wealth and of power. Now, another one that's a little bit newer, I would say, and yet still very old if you actually look at it, is thinking about having a nonprofit buy a business, a portfolio company, or an organization that's owned by other buyers. And this is something we don't have a lot of examples for, but there are some funds that do this. For instance, For Purpose, which is in Australia, has a nonprofit holding entity that they buy out large organizations, or not organizations, but assets and organizations, including schools, care homes, and others, and actually operate them under a nonprofit holding company. Another example of a nonprofit holding company is Newman's Own, which is owned by a foundation, and the profits from the business are plugged back into communities. And there are, similar to employee ownership, interesting opportunities around tax and financing advantages for sellers that would want to exit to a nonprofit. And I personally have been part of a for-profit being sold to a nonprofit of an organization that I was on the board of, and it was specifically for, it was a health care organization, specifically for the long-term viability of the mission to actually preserve it as a nonprofit. An example that many of you have probably heard of is Patagonia. Patagonia, the founder, Yvonne, actually wanted to exit the business, but did want to preserve the long-term mission. And so exited to a purpose trust, using something, an overarching term called steward ownership, and created a capital lock for the business so that the wealth would flow to the purpose as opposed to individual shareholders. Now, related are something called community buyouts. And this is where local communities actually can collectively acquire land, enterprises, or other types of assets, again, around increasing the distribution of wealth, power, and ownership. There can be cooperatives, different types of participatory investment, and these often, just similar to the nonprofit buyouts and even employee buyouts, utilize other types of capital to make the transition, but the ownership of the assets is held by the communities. So there are actually significant numbers of examples of these. Community land trusts are a good example of how to understand them. Nonprofit land trusts. This is a combination now of nonprofit and community come together to acquire housing, and then the seller exits, and then the ownership shifts to the organization with the tax benefits and the ownership. And an example of an organization that's done this in Canada is the Fernwood Neighborhood Resource Group. As examples in the United States, Europe, and Africa that I am aware of, as well as Latin America, and I'm sure there are ones in Asia too, but I've not seen those, whereby Fernwood, which is a community-based nonprofit, purchased a building to renovate and include affordable housing units, and the commercial space was then leased, and the ownership of that continued to reside with this resource group to be able to continue to exist as an organization and distribute that wealth. Now, shifting gears a little bit from kind of buyouts to the actual underlying mechanisms by which you do investment is something called redeemable equity, which is a part of structured exits, which I am very lucky to be on the call with Andrea, who I believe pretty much created that term. Hey, with your reports. Pretty sure that was you guys, which I've been building off of in my work for many years. And this is where an investor in the investment documentation structures the exit opportunity by saying that the founder has the right to buy back those shares from the investor. And there are other ways of using dividends to do this, but the fundamental idea of this is that investors buy shares into a company and the founder has the right, or a group within the company, not just a founder, has the right to repurchase those shares. And this type of redeemable equity or other dividend exits can be used to facilitate the types of buyouts that we were talking about at the beginning. So an example of this, also one of the chapters in my book, is called My Turn, which is a lending library software, and for community lending libraries. Fledge, which invested in My Turn, did so through redeemable equity because My Turn did not want to continue to take additional venture capital down the line. And so over time, over 7 years, Fledge's shares were bought back by My Turn, allowing My Turn to continue to exist as a company without needing additional capital and without needing to exit. My Turn still exists as a business run by its founders, helping community lending libraries able to exist and be able to lend out goods. Now, taking that idea a little bit further is an idea called impact buybacks. And I'm not wedded to this term. We can call it something else. I've been floating this idea for a while, and it's taken various forms. One example I'm going to talk about today. But the idea with this would be similar to redeemable equity, but instead of repurchasing the shares, is that impact actually repurchases those shares or reduces the amount that those shares own. And this is where the idea is that particularly for impact first or very impact focused organizations, to be able to incentivize for-profit or social enterprises to prioritize impact. An example of this actually is in a new note that was created by Roots of Impact called the SAFI, the Simple Agreement for Future Impact. The case I have here is Aqua for All, investing in pure fresh, using a SAFI, the Simple Agreement for Future Impact, whereby by achieving additional access, pure fresh does affordable and clean water. The investment from Aqua for All into PureFresh, the amount of shares that are owned can actually be reduced based off of the impact achievement. So similar, this is a type of impact-linked financing, similar to impact-linked loans and others, but done from an investment agreement perspective. Can be similar to a revenue-based financing agreement. There's a lot of different ways to do this. Another way that there are examples in Europe, for instance, Faird has a safe that they use that the number of shares that it purchases decreases based off of the impact that is achieved. And so what we're doing here is essentially substituting the ability to buy back the shares with impact buying back the shares. Now, this last one I'm not totally sold on, but I feel like has to be in here, and I'm not sure what exactly we're going to do with it, but we're going to do something with it. And that's around kind of impact mergers and acquisitions. And Andrea and Tina and I were discussing before the call, but there's something here around types of vehicles or whole roll-ups or secondaries whereby there can be impact-focused M&A or buyouts, whether it's secondaries or full buyouts. And I don't exactly know what this looks like. I think there's something here. There's the example that I've got, which I wouldn't say, I mean, I love Bridges. It's a wonderful organization, but I don't know if this is exactly it. But the idea being kind of investors buying up either shares or full organizations into some of these roll-ups that are, specifically impact focused, and potentially maybe even it falls under nonprofit or other types. And so, as I said, this is very early thinking, so it's not as clear cut as most of it would be, but that is the very early toolkit, or kind of thinking around what would it mean to not just responsibly exit, but actually exit with impact and the ideas of creating additional impact in your investment look like. I think I will say again, this thinking needs to go a lot ways further, and there are a group within the Innovative Finance Initiative that will be taking this further. And so if you are interested in that, please do reach out. So with that, I'm going to transition over to our conversation. Please, if you have questions, throw them into either the Q&A or the chat. We'd love to have questions to be able to do. I've got lots of questions for our discussion as well. So I'm going to stop my share here. There we go. All right. Great. Tina and Andrea, welcome. So pleased to have you here. Thank you for joining us. Andrea, thank you for taking time out of your very busy climate week. I appreciate it. And Tina, thank you very much for taking the time out of your very busy schedule as well. So I think we'll kick off first with why does this topic matter to you? Tina, can you start us off?
I can, and I'll try not to make it too long, but maybe just to introduce Bestseller Foundation. We're an impact investor in sub-Saharan Africa. We invest early stage, predominantly seed to Series B, and mainly in climate tech and tech-enabled job creation. We also fund systemic or catalytic interventions that make it easier to build impactful companies on the African continent, and obviously also how to invest in them. And we've therefore supported the Innovative Finance Initiative, which Oni also leads, and the working group around developing an exit toolkit for founders and investors. But I should say that what I say today, because this is very much a global context, and I can see a lot of the people in the chat are from all over, which is exciting. But what I say, I predominantly say from an African ecosystem lens. And two key points on why this is important for us. I think firstly, it's important for us, for founders, and for the ability to build sustainable, impactful companies. And I think it's a little bit of a cliche to say this, but the potential of investing in Africa is underrated and the risk is overrated, right?
Yeah.
So it's harder to raise capital and the right capital in an African context, which means that founders therefore often raise small rounds, small individual commitments, which means they spend a lot of time fundraising, but they also add a significant number of investors on the cap table, which makes everyday operations a little bit tricky, but it also makes long-term decision-making and the preparation of an exit quite challenging. So that alignment around what exit we're looking for, is it a founder-friendly one? Is it an investor-friendly one? Is it built around a liquidity event at a specific time or multiple scenarios, etc., becomes quite tricky. And it's important to have that conversation, preferably in a board workshop, preparing for the last day on the first day. But secondly, I think it's also important for investors and for the business case that we're obviously building for investing in Africa, which right now, there's also a little bit of a floskel, but the system is built for entry, not necessarily for exit, and especially not for alternative ones. So when you look at DFIs, which is one of the bigger sources of capital in the ecosystem, they measure their success based on entry level deployment and how much capital they've mobilized through blended finance, etc. A little bit kind of simplistically said, but that puts less of a focus on secondary transactions. And that's what we need to increasingly be built upon. It can also lead to some level of misaligned incentives where investors are rewarded for deploying capital and not necessarily for building sustainable exit pathways. So we, yeah, the metrics might say that we're winning, but the reality is more complex to some extent. So we're super excited about building innovative finance mechanisms that also are palatable for investors and can quite easily be adapted and adopted by multiple investors in a deal, and that doesn't have an innovation risk that scare investors as well. So it's okay if it looks like a duck and walks like a duck, as in normal investments.
Make them boring. That's our job, right?
Make
To
them
make the
boring.
innovation
Yeah.
boring. Andrea?
So why this matters? I mean, I sit at NYU, I direct a program on social impact, innovation, and investment, and I sit within a school of public service. So no dig to our friends and esteemed colleagues from the Oxford Business School and other business schools, but we come at this really from the perspective that capital should be a tool. It should not be the end in itself, right? There are problems that we want to solve. So it shouldn't be all about what the investors want. We need the capital, but it ought to be structured in ways that helps the founders, the companies, the mission, the impact, and so on. And if you take an exit first approach in the way that traditional venture capital does, let's say, you end up reverse engineering from that desired exit. So fundamentally, what happens is that you end up leaving a lot of companies unfunded, going back to what Tina was saying, because you can't see this pathway to a traditional exit. So even ex ante, you preclude the opportunity for a lot of enterprises to have the impact that they could have. Or you force them to grow and expand in a way that is consistent with the investor aspirations rather than the founder needs or the company's needs. The examples are countless. I also would say, relatedly, that this matters because most funding out there is not traditional, right? A lot of the founders rely on their own savings, rely on, unfortunately, credit card debt, whatever they're able to cobble together if they're fortunate enough to do so. So we are really trying to expand who gets to be a founder, who gets to be an entrepreneur, who gets to have an impact by doing this, and not putting everybody in the same one box of a more traditional exit pathway. One more thing, just to clarify the conversation, I think, is that when we're talking about the exits, on the one hand, it's the exit that the investor gets, and the other can be the exit that the founders get or the exit for the company itself, right? And those can take very different dynamics. So if you subscribe to this idea that the investor should be there to help the company and be compensated for that, right? a lot of the redeemable models that we're looking at help say, great, company is doing well, it's going to be chugging along, it doesn't want to IPO, doesn't want to be acquired, we want to continue doing this and continue having this impact and reaping or harvesting that impact over the years. So you try to take out the investors. The other, which Oni also touched on, is the company wants to exit, so to speak, or the founders want to exit, go do something else. And then the idea is, yeah, how can we do that in a way that enhances the impact? But those are two different exit models, probably that we can dig into a little bit.
And I think they're different of different times, right, Andrea? So I think there's it's like companies aren't static, right? So there's different times investors can be involved. And I think often what we think about, like we do think of this like linear path of startups of like investors come in at the beginning, then you exit to, some large entity and then they go away. Whereas if we're thinking about kind of longer, more sustainable businesses, you may have investors come and go, or even founders, come and go if you're able to continue the longevity of that business. And that does look different than a quick, startup that's trying to scale. And so they are different conversations and potentially a different lifestyle, different types of the life cycle.
Yeah, and I think that very much goes to what Tina was saying about making this boring and mainstream, right? You know what the funding needs are now. If you do something that is a little too funky, you might be jeopardizing the possibility for other rounds of investing later on. Yeah.
Absolutely. Absolutely. No, totally. So you've already mentioned this, Andrea, around ownership, but what are these different, like putting a focus on these different exit models? What do you think they can do for the industry around this conversation that's often not had enough around kind of power and ownership around businesses and assets?
So we're looking at that extra level of impact here, which I would very much welcome. Where the more examples you get of this successful exits, the more people would think, "Oh, great! Let's really start thinking of capital as the tool, as the kind of ingredient that helps you get to where you want to go." And kind of dethroning the investor a little bit from the driver's seat, right? It shouldn't be about what the investors would like to see happen with this company as the fundamental notion here. Where I think the power piece comes in is that obviously, not everybody gets to be an investor. To state the obvious, it's very much dependent on the wealth inequality that is pervasive throughout the world. And yet, the ones that are creating the value might become owners or partial owners of this entity that they've contributed to. There's the employee ownership, as you mentioned at the beginning. On is certainly a way to do that, but it could also be through exits to community, to local nonprofit groups, not necessarily at the Newman Zone or kind of Patagonia, whatever it's called, like Searchlight Foundation. No, the foundation that they set up to hold ownership now. But there are just multiple groups of stakeholders that ought to be over time gaining some of the ownership stake. And by ownership stake, I mean both literally getting some of the economic upside that there might be, but also having a voice and a governance role in the companies that they've helped create.
Yeah, and I think that goes to, Tina, what you were saying around from an African perspective, right, of the risk, right, of investing in Africa is often overblown. And taking what Andrea just said around having all of these potential opportunities for other, buyers, holders, owners, different ways of exiting. One of the things that I see in my work also on the continent is that creating a plethora of exit opportunities does then like reduce the risk and the creation of investment theses that are only designed for fast growing, tech enabled, highly scalable businesses, which, are not the majority, or maybe shouldn't be the majority of businesses on the continent.
No, for sure. And yeah, you're speaking a slight detour there, right? Also, which could lean into the fund design, which I think is a trend that we're seeing where more and more funds are also taking, not going down that short-term 7-10 year tenure, but increasingly being patient, evergreen capital. We've always been one, which, is obviously a foundation's prerogative to some extent, but it enables us to be a long-term partner to our portfolio. And I think that has a lot of value. And the other thing you're saying is like, okay, yes, let's have a plethora, it's a hard word, of different options for founders. But I think one of the key things, also kind of coming back to my initial point, we've more focused on the deployment and not so much on the exit strategy. And I'm also looking at myself here, right? We've gone through a very specific learning journey of not being as focused on the exits from day one as we should have been. And we're now starting to increasingly work from an exit framework that kind of looks at how do we ensure competitive strength? Is the company financially sustainable? Is it ready? How is the industry? How much time and effort would it take us to get it exit ready, right? Who's got the decision making and the influence? And also, because we often have so many investors on the cap table, there's not that one or two investors who can really kind of initiate and drive the process, which is a little bit of an issue sometimes. So that's also just an encouragement to founders to really kind of get your board aligned around what's the exit journey and what do you also want out of it, as Andrea said at the beginning. But I think where we're at now is a very specific focus now on, okay, great, so where are these exits going to come from? Impact investing in Africa is what, 10, 15 years old, like officially since the coin. Obviously it's been going on for longer, but we're at a time now where we really kind of need to also demonstrate the proof is in the pudding. So there's a lot more focus on the exits now, which means we might need to increasingly start focus on the instruments. And I think that's where we as investors can play a lot bigger role to say, okay, great, is it revenue-based financing where it's somewhat easier to exit? Is it the redeemable equity, etc.? Or how do we design these bigger partnerships between different investors in the value chain? How do we partner up with bigger funds, with PE funds, etc.? How can we bundle different sectors, etc., potentially to create new instruments? But essentially, we need to create a little bit more self-liquidating instruments. Sorry, that was a very long-winded response to your question.
No, I mean, I think we both agree. Yeah, I mean, Andrea, you know, how old is the report that you wrote on LATAM? Is it 10 years old, 11 years old?
It's coming up on 10 years, I think, and it's still, I actually looked back through it for one of my courses, and I was like, okay, we're still talking about this thing, so it's still relevant in some ways. On the sad part, we haven't made as much progress in mainstreaming things, but hopefully that's where the Innovative Finance Initiative comes in taking some of this work forward.
But what do
But
you
we
think
ever
is
see.
it? Oh, go ahead. No, go ahead.
No, I was thinking with what Tina was saying and reflecting back on your first slide about the opportunities that lie in this. We're not designing a system from scratch here. There's a lot of early stage financing that goes around. So the idea is really to understand what are the constraints that each of the actors faces, right? Or that differently situated investors might face over time. And how can we think of those not as constraints, but to your slide, as opportunities, however it was framed, right? So somebody has a shorter timeline, maybe they need to exit, which is one of the reasons why oftentimes there is this pressure on companies to grow fast, right? Okay, great. What can their shorter timeline capital be good for? Somebody has long-term liabilities and they want to have some kind of steadier stream of distributions that come out of their investments. Great, that's an opportunity, right, to line them up with the type of enterprises that would be suitable for that. So that's a bit what I was thinking when thinking about like how do we actually activate these investors. It's not a matter of saying, oh, what you're doing is not good. It's like what you're doing is not necessarily fit for purpose, or you're trying to like fit a square peg in a round hole,
Yeah, and I think that's where it goes back to, a lot of the financing for these for these organizations, like things like supply chain financing, for instance, and revenue-based financing and others are actually taking things that are available to very large businesses that have the opportunity to say, this is my need at this time. This is how I want to engage investors. I'm Vodacom. I need short-term debt. I'm going to go out and, issue a 1-year bond for something, or I'm going to go out and do a 30-year, or I'm going to use a credit line. And the thing is that, nonprofits, social enterprises that are small, startups, organizations that are in countries that, do not have, very active, credit, don't have access to those things. And so I think this conversation is very much about, how do we think about the way in which that capital is used at different times? And there's both going forward, and there's also historically, as Tina said, a lot of impact funds are in year 5 or 7 right now. Some are in year 10, but a lot, like more than we've ever had ever, right? Because of the length of time that it has been around, and because of the amount of capital that was raised 2018, 2019. And so there is a possibility that these funds, because they have a lot of them, almost all of them, are 10-year funds that are trying to return, that will start to force the sale of some of these impact-oriented businesses to the detriment of those organizations. And so I think that this thinking now about like, well, instead of just making sure that you limit the downside of like getting out of this company, what are ways that you can actually think about, and it may not be prioritizing the financial returns, but at the same time, there's also realism, right? So if you're going to get out of a business at 2 times what you paid for it, or 0, you're going to run that to 0. And there is a sense of realism here. And I think I've seen that engaging with a lot of investors around their math works for their fund if they are able to have a lot more of these lower exits that are considered failures by the market. And so instead of just kind of writing those off, how do we as investors really think carefully about what types of communities could benefit from the ownership of this nonprofits? Now, there's a question in the chat that is a very good one. What are the downsides of more distributed ownership? Andrea, have you looked at that at all?
Yes, I think it's a terrific question, and one that probably warrants its own webinar.
Yes.
See how I can think through it, because I'm thinking about it first from a governance perspective, because honestly, from an ownership perspective, it's hard to say without any kind of parentalistic take, like, oh no, it would be bad for somebody who hasn't owned something to become an owner of it, right? Fundamentally thinking of that as part of the exit this way. Governance-wise, there is a reason why the system works the way it is. And I don't think it is because there's a cabal that is pulling the strings. It's because it kind of like all the pieces kind of make sense and work well together. And if you are counting up dollars and you have a clear sense of what the return is to the investors and to the pensioners behind those investment funds or whatever else, right? It's easy to do it that way. And it starts getting really complicated when you start having different stakeholders that are involved. And one potential downside that I think we're very attuned to is that, accountability to everyone means accountability to no one, or conversely, that you turn groups of stakeholders into owners, let's say into shareholders, and then they end up acting just like shareholders, right? There's no reason, I think, why, say, a worker that has been excluded from share ownership her whole life, when she becomes a shareholder, should act like anything other than a shareholder, right?
Mhm.
So I think that's one of the issues that we need to look at. If the person that asked the question wants to elaborate in the chat, because it might be that they were looking at a different nuance there, we can get into that too.
Yeah, I'll read the question. It's a good one from Shani. What are the negative implications or fallout in terms of reputation for nonprofit community impact buyouts? I'm wondering because in the African context, even the term impact investing for example, sometimes has a soft connotation that some LPs, GPs, investors steer away from? Do these friendly exits have a bad reputation or signals for the fund that still wants strong commercial returns? So I took it a different direction. It's actually a two-part question, and I think the second part is good, but I think the first part, I wanted to address the first part first, which is also from a reputational perspective, or in general, from perspective, there are downsides, right? Companies can go under if a lot of people own them. That doesn't stop them from, ceasing to exist. And so I think it's not that this is a panacea. And agreed with what you were saying is that distributed ownership doesn't always mean distributed governance. For most organizations, still having like slightly more concentrated governance allows them to function, even though they have distributed ownership. And so there are ways to do that. But I think the second part of the question, which Tina, I would like you to opine on first, is around this idea that people start doing these soft exits, and we definitely should not call them that. We should definitely call them impact enhancing. Like, let's get the terminology to be good as opposed to bad. What do you think? What signal do you think that would have in the market?
I think if you can find a way that returns everybody's investments 2x, you're going to be very popular. So, so I think it's also, as you said, right? It's about realism, and I don't think this isn't. Yes, so sorry. In terms of the question, right? Is there a bad connotation to these software exits? I really don't think so. I think we need to think about it a little bit differently. So right now, you can either go, obviously, the secondary sale route, you can do the strategic exit, and we're seeing a lot of interest around that, but I think fewer to some extent examples of that. And we're not exactly talking fintech and telco, but like all business sectors on the continent. Then I think we've done, there's quite a lot of interest in potentially pursuing that. And sorry, my words, 7 months with a baby trying to learn how to sing a Rastless song is a little bit tricky. But no, so I think it's not necessarily about a soft exit, right? It's about finding different options for how do we navigate this. I think there's a limited liquidity in the system. We all want to try and find solutions for that. We also all want to try and find more easy ways of building this in from the get-go. And if we haven't done it from the get-go in terms of getting alignment from the investors to say, okay, great, what kind of business do you want to build as a founder? Are you building something for like 5 or 10 years? Are you building a family business for forever? Or like, what are you building for? If we can get that alignment, and then we can link up an instrument that can put your capital interest on it, as Andrea was saying before, right? Like, do you want to get out and get liquidity, or can you be there for longer, etc.? Or can we just say, let's link impact up to this and let's get the liquidity out of it, and then it's self-liquidating after a certain amount of years. We're all very happy.
I mean, I do think that's something that to underline, right? I mean, is that investors do want capital back. I mean, obviously we could talk about different types of return expectations, but I think that's something that, and Jenny, it's a really good question in that, like, if you're not getting a 10 times exit, what does that mean? But, investors are quite happy to get capital back. And so if we reframe it and say, instead of, hitting a 10 times, because that success was something that we inherited in the impact space. It was not something that was built in and purpose built, as Tina said earlier, for the funds. And so I do think, like, framing success as not just we exited and we created this many owners. We, are now in perpetuity funding these types of nonprofits. Like, I think we need to have some of this language start coming into this conversation about, like, what did you do at exit? And, like, also into some of the impact reporting, right? Because a lot of impact reporting, especially with access, is like, we gave people access. Well, if the company ceases to exist when you exit them, those people no longer have access to healthcare, education, etc. And so, having to be responsible for that continuity, but seeing it as part of the exit going forward, I think is really important.
And there's two elements to this, right? So one thing is also the wealth generation on the employee side. And we've seen Danish, right? So like what we've also seen great examples of in Denmark is the same amount of shares gets distributed across a startup. So if you're a receptionist, if you're the CFO, if you're the CEO, get a same amount of kind of shares to start off with. And it's created significant wealth if the company does well, right? We also see some of our bigger corporates that like our biggest dairy companies and our biggest kind of pork businesses, etc., that does more than 8 billion euros a year, they're all owned by everybody and by me sitting here. And you get distributes. And also a lot of our big companies, most iconic companies like Lego and Carlsberg and Novo Nordisk are owned by corporate foundations, right? Also to kind of keep the mission and the alignment. So there's a lot of good examples of kind of making this work. And the other thing is also just on the founder side, kind of coming back to the African context, what we see a lot of founders, you also, once you've started a company, you're in it to win it because it's really hard to get out. So now you're spending 10 years building this company. I think it's also kind of fair because it takes longer, right? And it can be hard. And you've raised your first round, then you need to extend an extension round, then you need to prop on a significant discount to do a bridge round and stuff like that, right? And now you kind of ended up with, to some extent, a bit of a dilution, and you're still in this company making it work on a daily basis. And we work with amazing founders who's very committed to the companies, building companies for their families and for perpetuity, perhaps. But I think it's also fair to have that conversation about how long can we reasonably expect, also as investors, for founders to be in there and give them potentially also a way out, but also a way of getting some wealth generation out of it.
Yeah, Andrea.
Yeah, and I want to pick up, and somebody I see Patricia just put in the chat.
Yeah.
There is a certain myth as to what these returns are from more traditional exit pathways, right? And
Totally.
if you compare, what a fund with its own power distribution can give you back versus a structured exit that might give you 2.25x versus 2.3x, like the difference is not that much. And I imagine if investors were open to it, they would see that the visibility towards the actual exit, especially in geographies where there is no thriving M&A market, where an IPO might be very much aspirational, like you should think hard about, like, okay, would I rather have a guaranteed 2x, or not guaranteed, but like a plausible 2x, or hold out for this 10x that I've read about but I haven't really seen. The other piece to this that I think very much ties to what Tina was saying about the entrepreneur perspective is that the only way that you can achieve kind of super normal returns in a traditional funding model is by taking a lot of risk. And for the fund, for a traditional venture capital fund, and I can plug your adventure finance book in this, right? It is pretty. It is built into the model. They expect this 70% of failures or whatever. If you are the entrepreneur, if you're the founder, if you're somebody that works there or a person in the community that relies on whatever goods and services are provided, you're not agnostic. You're not indifferent if this company fails or
No.
not, right? Because you don't have a portfolio of them. So the way that you get to those returns is by shooting for the moon, and whoops, if some of them fall by the wayside, the investor might not care as much. The entrepreneur very much cares. So I would think of the risk of the growth as much more holistically, not just thinking about the risk that is built into the model for the VC investor here.
I love that point, Andrea. And I think that's something that, I was looking back through some conversations and prep for this, and there was a case in Australia where it was a very large foster care system, or foster, essentially childcare centers that were for children that were in care in Australia, and that was purchased by a private investor, and thinking about eventually shored up, but thinking about like if those things, and we see this in the States that have like you have these social assets essentially that are allowed to fail in the pursuit of higher returns for investors. And I think it's a fundamental question to ask about. There's two questions here. One, I think, which we've been discussing around, how, like, what does success look like for a, risk capital funder in impact? Success probably doesn't look like one of those companies shooting the moon and everything else failing, because as you've said, there is collateral damage there. You have a bunch of people that had signed up to get access to healthcare and suddenly don't have clinics because you've just let them fail. And it's not to say that you prop up businesses, but like going out there with this idea that only one succeeds. So reframing this narrative in the impact investing space of like whole portfolios succeeding as opposed to and then you start to think about what does it take for a whole portfolio to succeed. And I think that's where pushing beyond the just responsible exits to like how are we making sure that the portfolio approach to this, the ownership of these 10, 12, 15 businesses is actually creating additional impact. And then I think there's also something there maybe a little bit more controversial, but around like who should own assets. Should private equity or private investors own things like care homes or, schools? And if not, then these kind of nonprofit holding and different types of actual structural steward ownership in like perpetual purpose trusts, et cetera, might actually be better. And if that's the case, then exiting to those types of organizations might be impact in itself. So it might be, I think there's ways to think about distributive. So how do we make this the wealth and the power more distributive, but then also how do we in some cases protect it by putting it into things like steward ownership? And I think right now most of the exit conversation, if not almost all of it, is how do we get out of the business as opposed to continue the impact further on.
I'm so not going to take the bait on the private equity and care homes, but I did want to say that there are some good examples of this like holding company model. Aquaspark was one of them that goes precisely to what you're saying, right? Bringing together companies so that you create more impact through the kind of having thought out the entire ecosystem. This was even before like the kind of systemic investing approach became more palatable, but was really saying like, if we put all these companies together, why would we want to leave them, right? Once we have created this ecosystem, it actually makes sense even from an investor perspective to keep it in a holding company. And in the US, there's a recently 9 launched, which is trying to have like an impact holding company model of the sort, where the underlying portfolio companies might not be impact enterprises per se, but the investors can bake in impact, right? They can improve the practices, have partial exit to the workers, and so on, right? Where it's actually the work of the holding company to create the extra impact for the other stakeholders.
Okay, I'm going to quickly do a quick rattle off. There's a ton of questions. So we're going to try and get through some of them as quickly as possible. These are great questions, and the chat also is like incredible. So I will just say before we start smashing through questions, just quickly that I'll put a link in here. But the Innovative Finance Initiative, which Andrea and Tina are both a part of, is a place that to have these conversations and do stuff about this. I know there's great questions and requests for like toolkits, better ways to like think about this. Like they don't exist, unfortunately, right now. So we need to build them. That's part of what we're starting to do. That's part of what I think this conversation and others is that this is we are planning to start doing that. And then also there is a if you want to come and have this in person, please join us in Oxford for the Impact Finance of Innovations course, and I will put that link in the chat as well. But let me do a quick run through of some of these. So Jesse asks about government or public sector acquisitions or exits. That's not something I'm familiar with. Tina, Andrea?
No, not either. We've done a lot of work in the circular space and in the waste space, where it's something we often think about, like, okay, great, do we set up this waste infrastructure and then all of a sudden the government comes in? We haven't seen examples of it, unfortunately, but it would be interesting to explore.
Yeah, it's an interesting one. I think it is an interesting one.
Did you say government buyouts?
Government. Yeah, government buying out. It's not something I've seen. It's an interesting one. Yusuf, KICs can't really exit, but they can do things like revenue-based financing and others because they have a capital lock. Rowena, really good question around guidance around negotiating an alternative exit. So Andrea has had, as we said, a report that he wrote back in the day. We can put the link in the chat. But then also I've got in adventure finance, there's also I think some good, I'll put a link here too, some good stuff around that, but there is more that needs to be done. And then also the playbook that I put up, we've got some good kind of, I think, pieces around thinking about redeemable equity and other types of dividend producing, like how to think about from a founder perspective. Namindra, how can we better equip impact investors with knowledge? Well, I think Andrea and Tina, I think that's what we have to do, right, with the mission. I don't know. I was trying to think, I was looking at like resources for this. I like couldn't really come up with many other than like impact terms project had some stuff. Obviously, Andrea, you and I have written a lot about like the structure side, but not necessarily on like kind of the alternative buyout side, at least from my perspective. Felipe has a question about speaking with impact fund GPs. What are their takes on these structures? That's a great one. Tina, what do people think about alternative deals, redeemable equity, revenue-based financing, etc.?
Oh,
Oh,
I think everybody is intrigued. So I think, and I think there's a solid recognition that there is a need for this, right? Like full stop. But I think there's also it comes back to this innovation risk. So, and how many instruments you put on a cap table. And it
yeah.
just is the fact that one convertible under one shareholder agreement is just that we can all update. It's just a lot easier than having one investment with redeemable equity, and then some investors don't understand it and stuff like that. But it's work in progress, and there's interest. But I think we have more work to do in order to make them a little bit more palatable and increase knowledge of them.
Andrea, have you seen a change over time?
No, but I'm glad to see that there is still a lot of appetite. So I think that there should be some economies of scale, presumably, and things should be getting faster once more of the lawyers, of the general advisors get familiar with this. I saw, yeah, there was something like, how long does it take to structure an exit? It's like some of the structures like will get easier over time. Like all this stuff took a long time at the beginning. I will also say there's a lot of knowledge that is sitting out there that has not yet been implemented. Like when we're talking about the secondaries, I remember back in the day, Include had put together some design for a facility that was going to be an off-taker of impactful companies. And the theory of change
There
there
is actually
was that
one. I'll put it
they
up. It's
did do that.
October.
Yeah.
October it became. I'll put it up in the chat as well.
Yeah.
So that
And the
actually,
idea there was that
yeah.
presumably you would bring in more investors on the front end if there was some assurance that you would have like an off-taker down the road. So a lot of these things are out there, and they will speed up once there is a bit of critical mass, a bit of a momentum there.
Yeah, and I can't find the link, but it's all called October that's what it essentially became. And yeah, so I agree, and that's to Caitlin's question around like, you know, potentially secondary market. I think Caitlin, 100%. There needs to be kind of impact secondaries that are able to kind of buy out some of these, aggregate them long-term holding. And I think one of the things we were also talking about, that's one thing, but I think we can't rely just on additional financial institutions buying. Like there has to be things that are like longer term, and that's where we're talking about some of these community buyouts, employee buyouts. Like, you know, I think that's where, you know, Caitlin, if that's the only thing you're thinking, instead looking at, for some of the founders looking at these options, hey, I've taken VC capital, but going back to these and saying, hey, I think I could structure a 2x return for you, you know, being able to access debt and then selling it over time to employees, you know. And I think there's having that conversation, and what does a portfolio win look like for large company or for VCs is really important. And Janice has a final point here, which is, how do we change our mindset related to exit risk? We need to change in perspective from risk to taking risk, from a noun to a verb. Risk as a noun means danger, peril, threat. To risk as a verb means to adventure, be brave, move the money. I like it, Janice. And Janice has done a lot of work as a fund manager around structuring structured exits. Okay. Oh, thank you, Christine. Wonderful. Well done. October is in there. I would just like to say thank you very much. I have not been able to keep up with the chat, which is new for me. Normally I'm able to do that, but the things that were being said and the things that were in the chat were super interesting. And I just think it goes to say that there is just a ton of demand for this. And Sumit, I did see your question. Feel free to join us at the Innovative Finance Initiative. I'd very love to have this ongoing conversation. I would encourage anyone to join us. Come join us in Oxford. Tina and Andrea, for your final question, what do you hope this conversation looks like in 5 years?
I'll go first. Well, I was just thinking, what do I really hope we get out of this toolkit? If we can get two things out, one, a toolkit that can ensure that the employer ownership creates wealth also on the continent, that would be amazing. And two, if we can have structured exits that creates portfolios with the intention of kind of creating 8 out of 10 companies that succeed instead of 2 out of 10. That's great.
I'd love that. Andrea?
Yeah, I'd like to see a little less of the hesitation, as Janice was suggesting. Say like, yeah, somebody needs to be among the first movers here. We've given some good reasons to do that. Others can add more reasons to that. In a few years, it's as a concept, it should be de-risked, and it should make it easier to move in that direction. Because clearly, something that we're doing now is not working right. So might as well try something new.
Absolutely. And I think the thing to remember too is that a lot of this stuff is not new per se, right? It's actually doing things that are, we look at cooperatives in Europe, we look at employee, like, the first, like this is actually like, it's new from the 75 years that we've been dominated by the Friedman ideology around shareholders at all expenses and kind of, finance for the expense of, or for the end result of finance. Thank you, everyone. Lovely to have you all. Thank you, Tina. Thank you, Andrea, for taking the time. And hopefully well, I know we're going to continue the conversation because we will see you in about 3 weeks to continue the conversation. So see everyone very soon. Thank you very much.
Thank
Bye
you
now.
so much, Ronnie.
Thank you.